Welcome to the deep dive. Today we're looking at something maybe a bit unexpected, a potential upside for REIT investors that seems to be connected to the ongoing influence of former President Donald Trump.
Interesting angle.
Yeah, and it's not just about policies from when he was in office. It's more about how his continued presence and commentary might be shaping things now.
Right. Affecting the economic landscape, which then ripples out to real estate investment trusts, REITs.
Exactly. So if you're invested in REITs or even just thinking about them, this is a deep dive you'll probably want to stick around for.
Definitely. And maybe just a quick refresher on REITs.
Good idea.
Okay, so REITs, real estate investment trusts. These are essentially companies that own or sometimes finance real estate that produces income.
Like office buildings, apartment complexes.
Exactly. Shopping malls, warehouses, hospitals, data centers, storage units. It's a pretty broad range. And importantly, they trade on stock exchanges, just like regular stocks. And they're known for paying out dividends.
And the key thing for today's discussion, they can be really sensitive to policy changes, right?
Oh, absolutely. Interest rates are a big one. Tax policy, zoning regulations, housing incentives, even things like corporate regulations can all move the needle for REIT performance.
Okay. So our mission today is to really unpack how Trump's policy ideas, his economic signaling, even just his influence out of office might be creating some, let's say, opportunities for REIT investors.
Yeah, trying to get some clarity on why this might be happening and maybe which types of REITs could be most affected. We've got some interesting source material to work through.
Great. Let's dive in then. So this Trump effect, as some might call it, even though he's not president, there's this idea that his influence on economic thinking persists, a kind of business-first mentality.
And that often tends to favor industries like real estate.
So how does that translate to REITs specifically?
Well, his voice definitely still resonates in certain economic policy circles. There was a fascinating example recently at a conservative economic conference. Some advisors linked to Trump were discussing reviving a 15% flat corporate tax rate.
Right? I remember sharing about that.
And almost immediately, you saw a positive reaction in the market, including for REITs. Now, REITs themselves generally don't pay corporate income tax because of their structure.
That's what I was thinking. So why the bump?
It's more indirect. It's about the tenants. If the businesses renting space in REIT-owned properties suddenly have a lower tax burden.
They're healthier financially, more likely to pay rent, maybe even expand.
Exactly. Fewer defaults, more reliable income streams for the REIT. It strengthens the foundation, like you said earlier. It's about tenant solvency.
That makes a lot of sense. Okay, and it gets even more direct, right? Trump has hinted at bringing back parts of the 2017 Tax Cuts and Jobs Act, the TCJA.
Yes, and specifically for REIT investors, the really big one was that 20% pass-through income deduction for certain REIT dividends.
Okay, break that down. Why was that deduction such a significant factor for people holding REITs?
Sure. So that provision basically allowed individual investors to deduct up to 20% of their qualified dividend income from REITs directly from their taxable income.
Wow, 20%.
Yeah. So imagine you're in a higher tax bracket. That deduction could significantly lower the effective tax rate you pay on those REIT dividends.
Making REITs a much more attractive source of income tax-wise.
Precisely. So the mere potential for that deduction to come back, or maybe even be expanded under a future political climate influenced by Trump, acts as a pretty strong incentive for REIT investment. People start factoring that possibility in.
Okay, so it's less about laws on the books right now and more about reading the policy tea leaves, anticipating a potential shift.
A lot of it is, yes. It's about the potential for an environment that leans towards, say, lower taxes on investment income generally.
Or maybe lower capital gains taxes.
Could be. Or maybe a generally weaker corporate tax regime, which we just talked about with tenants. Even things like repealing estate taxes.
Yeah.
That has knock-on effects for real estate holdings.
Right, because real estate makes up a big chunk of many estates.
And then there's infrastructure spending. If that gets directed towards key property markets, that can boost values.
So how does each of those potentially help REITs? Let's tick them off. Lower investment income taxes.
Pretty straightforward. Higher after-tax returns for REIT investors. Makes them look better compared to, say, bonds.
Lower capital gains taxes.
Encourages holding REITs for the long term, potentially leading to more stable ownership.
Weaker corporate taxes.
Healthier tenants, as we discussed. More reliable rent. maybe more demand for space,
Estate tax repeal.
less pressure for heirs to quickly sell off large real estate assets, which could support overall property values.
And infrastructure.
Targeted spending roads, transit, utilities can make the areas where REITs own property more valuable, more desirable for tenants, boost demand and maybe rents.
It's interesting how interconnected it all is. And didn't we see a specific example with healthcare REITs reacting to a policy proposal?
Yes, that was notable. Healthcare REITs saw a jump, I think it was nearly 5% actually, after a think tank, one aligned with Trump, put out a proposal related to Medicare privatization.
Okay, what was the thinking there? Why would Medicare privatization boost healthcare REITs?
Well, the underlying idea is that if Medicare moves towards more privatization, it likely means a greater role for private healthcare providers and companies.
And those private companies need facilities.
Exactly. They need the nursing homes, the assisted living centers, the medical office buildings that healthcare REITs own and operate. So the market saw that potential policy shift as a future driver of demand for those specific types of properties.
Interesting. Okay, let's shift gears a bit. Let's talk interest rates and inflation. This one feels a little counterintuitive. Trump has often criticized the Fed for raising rates, wanting lower rates. How could that narrative potentially benefit REIT investors?
Yeah, it seems odd at first, but it makes sense when you remember how REITs often operate.
They use a lot of debt.
They often do, yes. They use debt to buy properties, to fund development. So their profitability is quite sensitive to borrowing costs.
Ah, okay. So if rates are lower, or even if there's just talk of keeping rates low.
Their financing costs are lower. That can directly boost their profits, their funds from operations or FFO, which is a key metric they use. And it makes their dividend yields look more attractive compared to bonds when rates are low.
And lower rates can also stimulate the economy more broadly, right?
Generally, yes. Cheaper borrowing can encourage businesses to expand, consumers to spend, developers to build, all of which can lead to higher occupancy rates and potentially higher rents for REITs.
So even just the political pressure or the narrative around wanting lower rates can subtly shift investor sentiment towards REITs.
It can. Markets often react to expectations. If the expectation builds that rates might stay lower for longer due to political influence, that can be perceived as a positive for rate-sensitive sectors like REITs.
Okay, that clarifies that connection. Let's get more granular now. Which specific REIT sectors seem best positioned to, well, maybe capitalize on this environment? Industrial REITs seem like an obvious one.
They really do. There's a strong connection to the America First rhetoric, the focus on manufacturing, and this whole trend of reshoring or nearshoring supply chains.
Bringing production back to the U.S. or closer to it.
Right. And what does that require? More domestic warehouses, more logistics centers, more manufacturing facilities, those crucial last-mile delivery hubs for e-commerce.
All properties that industrial REITs own.
Exactly. So companies like Prologis or East Group Properties, these big players in the industrial space, are seen as direct beneficiaries of increased demand for that kind of real estate. The demand for warehouse space, particularly, has been quite strong.
Makes sense. Okay, what about residential REITs? The ones owning apartment buildings, maybe single-family rentals?
There are a couple of potential angles here. One ties into the general focus on housing and perhaps deregulation, if policies make it cheaper or faster to build.
That could help REITs involved in developing new apartment communities.
Potentially, yes. Also, if political pressure contributes to keeping mortgage rates somewhat contained, while that might push some towards buying, it also keeps the rental market very strong for those who can't or choose not to buy.
So, stable or growing demand for rentals.
Could be. Companies like Mid-America Apartment Communities, which has a big footprint in the Sun Belt, or Invitation Homes, which is huge in single-family rentals, might benefit from those dynamics.
Okay. And healthcare REITs, we touched on the privatization angle, but are there other factors?
Oh, definitely.
Yeah.
You can't ignore the fundamental demographic trend. The aging population. That's a massive long-term driver.
More seniors needing more healthcare services and facilities.
Exactly. More demand for skilled nursing, assisted living, medical offices. So you layer any policies that might favor private healthcare delivery onto that powerful demographic wave, and it creates a potentially very strong growth outlook for healthcare REITs. Think Welltower, Ventas, major players there.
All right, now for maybe the trickiest one. Retail REITs. Owners of malls, shopping centers, we all know the struggles of brick and mortar. How could they possibly see an upside in this scenario?
Yeah, this one requires looking a bit deeper, maybe even taking a slightly contrarian view that the sources suggest.
Okay, I'm intrigued.
Part of it ties into a potential narrative shift, maybe a bring back Main Street or revitalize American shopping sentiment. But more concretely, there's the policy angle around sales tax.
Ah, the online sales tax versus physical store sales tax issue.
Exactly. There's been ongoing debate about leveling the playing field, achieving sales tax parity. If policies move in that direction, making online purchases relatively more expensive due to consistent sales tax application.
That could make physical stores comparatively more attractive again.
It could help, yes. It might not solve all of retail's problems, but it could provide a bit of a tailwind for the landlords and the retail REITs, companies like Simon Property Group or Federal Realty Investment Trust. Plus, remember, many of these REITs are actively redeveloping their properties.
Right. Adding experiences, restaurants, apartments, making them destinations.
Precisely. So if there's a renewed focus on in-person experiences, combined with maybe a more level tax playing field, you could see some benefit there.
Interesting. So potential positives across several key sectors. Let's circle back to tax reform, though. The material really flags this as potentially the most significant catalyst. Why is tax policy so central here?
It really is foundational for REITs, especially from the investor's perspective. We already talked about that 20% pass-through deduction from the TCJA. That was huge for boosting investors' after-tax income from REITs.
And the idea is that could come back or even get better.
That's the speculation. The potential for it to be made permanent, maybe even expanded. Or imagine other investor-friendly policies being floated in a Trump-influenced environment.
Like what?
Well, maybe eliminating capital gains tax entirely on REIT shares held for a long time, or allowing for more favorable depreciation schedules on the buildings REITs own, which could boost their cash flow.
Or maybe expanding those opportunity zone programs to specifically encourage REIT development.
Exactly. These aren't just small tweaks. Changes like that could fundamentally alter the long-term attractiveness and profitability of investing in REITs. It's a major potential driver.
Okay, but we have to be balanced. This is all based on potential political shifts, and that comes with risk, right? It's not all smooth sailing.
Absolutely critical point. Political influence is definitely a double-edged sword. What looks like a tailwind today could easily reverse.
How so? What are the risks?
Well, public sentiment can change. Election outcomes are never guaranteed. The very policies being discussed could have unintended negative consequences.
For example?
Okay, take immigration. Policies that significantly restrict immigration could dampen demand for housing, both apartments and single-family, and potentially even office space in certain cities.
Okay, that makes sense.
Or tariffs. If tariffs are imposed on things like steel or lumber, that drives up construction costs for REITs looking to build or renovate. And you could even see pushback against deregulation. Maybe tenant groups become more active, or there are legal challenges if environmental or other regulations are rolled back too aggressively. It could get messy.
So it underscores that potential rewards often come with potential risks, especially when politics are involved.
That's the nature of investing, particularly in asset classes sensitive to policy. Risk and opportunity go hand in hand.
So bringing it all together for our listeners, given these potential upsides linked to this Trump effect, but also acknowledging the risks, what are some actionable things people might think about right now?
Well, first, let me stress again, this isn't about taking a political stance. It's purely about investment strategy based on potential policy scenario.
Understood. Neutral analysis.
Right. So with that lens, you might consider if your portfolio weighting makes sense. Does it make sense to perhaps tilt slightly more towards sectors like industrial, healthcare, maybe residential REITs, which seem potentially well-positioned for a pro-business, possibly deregulatory cycle?
Okay. Reassess sector allocation. What else?
Definitely make sure you're currently maximizing any tax advantages you already get from your REIT income. Understand the rules. And then stay informed. Keep a close eye on any serious proposals about changing those pass-through rules or capital gains taxes.
Pay attention to tax talk.
Absolutely. And watch for infrastructure bills. If a major bill passes, where is that money going? Could it significantly boost property values where certain REITs operate?
Location, 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 driven by policy.
Could be. And finally, when you're looking at individual REITs, don't just chase the theme. Look for companies with strong balance sheets, good management, solid fundamentals that also happen to have exposure to these potentially favored sectors or regions.
Fundamentals first, then consider the potential policy tailwind.
That's a good way to put it.
Okay, this has been really insightful. So just to summarize the big picture here, the key takeaway seems to be that the policies, the rhetoric, the overall influence associated with former President Trump have arguably created a surprisingly favorable backdrop for REIT investors in several areas.
Yeah, driven by potential tax benefits that pass through deduction looms large. Maybe a narrative favoring lower interest rates and some very specific industry trends, like in industrial and healthcare.
But as we've said, laced with uncertainty. Elections, shifts in sentiment, global economic factors, they all play a role.
Precisely. The future is never guaranteed, especially when politics and macroeconomics intersect. But the current dynamics do present some interesting potential opportunities for REIT investors to consider right now.
Okay, and maybe a final thought to leave our listeners with. Thinking beyond just REITs and beyond just one political figure. How could broader political and policy shifts, whoever is driving them, impact your entire investment strategy?
That's a great question.
Maybe take some time to think about what other asset classes or industries are particularly sensitive to major political developments. It could be a valuable exercise.
Definitely food for thought.
Thanks for joining us for this deep dive.